$67.30 per ounce. That's where silver closed yesterday, up 130% in 2025, the strongest annual performance since 1979. But that's not the story. The story takes place on January 1st, 2026, in 72 hours, when China flips the switch and essentially closes the door on silver exports to the West. Not technically a ban, but close enough. According to China's Ministry of Commerce announcement 2025, number 68, only state-certified exporters producing at least 80 tons annually will qualify for licenses. That eliminates most players. That's 60 to 70% of global silver supply that historically flowed from Chinese refineries to Western markets. Gone. We've seen this movie before. Act 3 of a 4-act play that always ends the same way. And if you understand the pattern, if you can recognize what comes next, you're about to see why this isn't panic. This is inevitability. Rome, Weimar, Nixon, the Hunt brothers, China, same pattern, different century, different characters, same ending. Let's start at the beginning. 270 AD, the Roman Empire is bleeding silver. Literally. The denarius, the silver coin that built an empire, started at 90% pure silver under Augustus. By the time Emperor Aurelian took power in 270 AD, it's down to 5%. Not 50. 5. Think about that. The coin that paid soldiers, that traded across 3 continents, that represented Roman power itself, was basically copper with a silver wash. The Romans called it adjusting the monetary standard. Financial engineering. Does that sound familiar? They had no choice. The empire was hemorrhaging money, military campaigns, infrastructure, bureaucracy. The debt became unmanageable. And when debt becomes mathematically impossible to repay, governments do what they've always done. They debase the currency. Stage 1 was borrowing. Rome borrowed to expand, to conquer, to build. That's what empires do. The debt was manageable at first because growth covered the interest. Stage 2 was the trap closing. Eventually, the debt grew faster than the economy. Interest payments consumed more and more of the budget. They weren't borrowing to invest anymore. They were borrowing to survive. The math stopped working. Stage 3 was debasement. When you can't repay the debt, you have 3 options. Default, which is political suicide. Austerity is also political suicide. Or inflate, which is slow suicide, but at least you stay in power longer. Rome chose door number 3. They clipped silver from the coins. They mixed in copper. They redefined what money meant. And what happened? By 301 AD, Emperor Diocletian had to issue price controls because inflation was so severe. Workers demanded payment twice per day because by afternoon, their morning wages couldn't buy bread. The empire didn't collapse from military defeat. It collapsed from monetary decay. But here's the part that matters. In all that chaos, while the paper promises and debased coins became worthless, what preserved wealth? Gold and silver? Pure metal? The wealthy Romans who saw it coming melted down the old coins. They stored bullion. Because when government promises fail, humanity always returns to the same solution. Physical assets you can hold. That's Act 1. Jump forward. 1400 years. Germany, 1922. After World War I, Germany owed reparations. Massive reparations. In gold, which they didn't have. So they did what every government does when debt becomes impossible. They printed. The Reichsbank fired up the printing presses. 24-hour shifts, not metaphorically, literally printing paper marks. In January 1922, $1 bought 191 marks. By January 1923, 17,000 marks. By November 1923, 4.2 trillion marks. A loaf of bread that cost 163 marks in 1922 cost 200 billion marks in November 1923. People would go shopping with wheelbarrows full of cash. Children played with stacks of worthless bills like building blocks. German workers got paid twice daily because their morning wages were worthless by afternoon. You couldn't even calculate prices anymore. The numbers moved too fast. Same pattern, different characters. Stage 1, borrow beyond capacity. War reparations they couldn't possibly pay. Stage 2, debt becomes mathematically impossible. No amount of austerity could fix it. Stage 3, print to survive. The Reichsbank printed and printed and printed until the currency was worth less than the paper it was printed on. But here's what the history books don't emphasize enough. In that chaos, while marks became toilet paper, there was one asset that held value across borders, across governments, across the entire collapse: gold and silver. The wealthy Germans who saw it coming converted their paper wealth into precious metals. They shipped it to Switzerland. They buried it. They hid it. Because metal doesn't lie. It doesn't promise. It just is. The hyperinflation ended when Germany introduced a new currency backed by land and hard assets. Not promises. Things you could touch. Things that had intrinsic value. That's how the pattern always resolves. Act 2, same pattern, just faster. Now let's talk about right now, December 2025. According to the Institute of International Finance, global debt hit $318 trillion in 2024. The debt to GDP ratio, 328%. Think about what that means. We owe more than 3 times what the entire planet produces in a year. For the first time in 4 years, that ratio increased. The US alone added over $2 trillion in 2024. China, India, France, Brazil, everyone's piling on debt. Not because they want to, because they have to. Interest payments on government debt are now consuming 15 to 20% of tax revenues in developed nations. That money isn't building infrastructure. It's not funding innovation. It's servicing debt on money we've already borrowed. We're i.e. debt trap, where you borrow not to invest, but to pay interest on previous borrowing. Stage 1, complete. We borrowed to expand. Check. Stage 2, in progress. The debt is becoming unmanageable. Check. Stage 3, starting now. The debasement phase. They don't call it debasement anymore. They call it quantitative easing, monetary accommodation, expanding the balance sheet, modern monetary theory. It's the same thing the Romans did, the same thing Weimar did, just with digital ledgers instead of clipping coins. And this is where silver enters the picture, not as speculation, as pattern recognition. Silver hit $67.30 yesterday, up 130% in 2025. But forget the price for a second. Look at what's happening beneath the surface. That's where you see the pattern repeating. In early December, COMEX, the major commodity exchange in New York, saw 47.6 million ounces of silver claimed for physical delivery in 4 trading days. That's 60% of COMEX's total registered inventory. Gone in 4 days. COMEX inventories have fallen by 73% since 2020. And lease rates, what it costs to borrow silver, spiked to 9% in London. Normal is 0.5% to 1%. 9% means someone is desperate to get physical metal. The silver futures market went into backwardation. That's when the spot price exceeds the futures price. Translation? People want silver now more than they want a promise of silver later. That only happens when the physical market is genuinely tight. On the supply side, the Silver Institute projects a 95 million ounce deficit in 2025. That's the 5th consecutive year of deficit. The cumulative shortfall since 2021, 820 million ounces. Imagine draining an Olympic swimming pool every year for 5 years. That's what's happening to above-ground silver inventories. Meanwhile, demand is accelerating everywhere. Solar panel manufacturing consumed about 200 million ounces in 2024. Electric vehicles need roughly 90 million ounces annually now. AI data centers is adding new demand. And investment demand, people seeking protection against currency debasement, is surging. Here's the bottleneck. Silver isn't like other commodities. You can't just mine more when prices rise. 70% of silver comes as a byproduct of copper, zinc, and gold mining. If those operations slow down, silver supply drops regardless of silver's price. My output grew just 1% this year. New mine projects are forecast to add only 44 million ounces over the next 5 to 10 years. Supply is rigid, demand is exploding, inventories are vanishing. This is exactly what happened before the 1979 to 1980 spike, when silver went from $6 to $50 in less than 2 years. Same signals, same pattern. We're watching Act 3 unfold in real time. The debasement phase, the flight to tangible assets. It's happening right now. But here's where it gets interesting. Where the pattern accelerates, January 1st, 2026, 72 hours from now, China's Ministry of Commerce has placed silver exports under what they call a state trading management system for 2026 through 2027. It's not technically a ban, but it might as well be. Only large state-certified companies that produce at least 80 tons of silver annually will be granted export licenses. That eliminates most exporters. Small and medium players are locked out. China controls 60 to 70% of the global silver supply. Not because they mine the most, they're the second largest miner, but because they refine the most. Chinese refineries process silver from all over the world and then export it to Western markets. That flow is about to get choked down to a trickle. Why is China doing this? Officially, to protect national resources and the environment. But let's be real, China needs silver. Their solar panel industry is booming. They're the global leader in photovoltaic production, and silver paste is critical to solar panels. Their electric vehicle industry is massive. Electronics manufacturing. All of it requires silver. And here's the strategic part. China learned from rare earth elements. They dominate global production. And over the past decade, they've used export restrictions as geopolitical leverage. Silver is the next rare earth element. It's a critical material, and China just weaponized it. The timing is not coincidental. Silver inventories on the Shanghai Futures Exchange fell below 500 tons in November. Record lows. China's domestic demand is outstripping domestic supply, so they're keeping the metal at home, and in doing so, they're cutting off the West. Think about the implications. Western markets have relied on Chinese silver flows for decades. Suddenly, that supply disappears. The existing deficits, already at 95 million ounces annually, could double. Some analysts are projecting the global shortage could exceed 5,000 tons per year if China reduces exports by 50%. That's not speculation, that's math. And Western mints are already running dry. Canada's Royal Mint is out of silver bars and coins. The US Mint is struggling with supply. London's physical silver market has been tight all year. Lease rates are spiking to 9%. Backwardation in futures. And now the main supply valve is about to close. Remember COMEX? 47.6 million ounces claimed in 4 days. JP Morgan's registered inventory, the so-called silver gorilla, has been cut in half, down to 16.8 million ounces in a world running multi-hundred million ounce annual deficits. And there's suspicion that during the supposed CME server meltdown on Thanksgiving night, which lasted 10 hours, large Asian longs were negotiating to pull massive amounts of physical silver. The server meltdown was the cover story. This is a supply crisis. Not a maybe, not in the future, now. And China just made it exponentially worse. Let's zoom out. Let's look at the full pattern. Act 1, borrowing phase. Every empire, every government, every monetary system starts here. Borrow to grow, borrow to expand. The debt is manageable at first because growth covers the interest. Rome did this, Germany did this, we're doing this. Act 2, the trap closes. Eventually, and this always happens, the debt grows faster than the economy. Interest payments consume more and more of the budget. You're no longer borrowing to invest, you're borrowing to survive. The math stops working. Rome hit this, Weimar hit this, we're hitting this now. Act 3, debasement. When debt becomes mathematically impossible to repay, governments have 3 choices. Default, political suicide; austerity, political suicide; or inflate, slow suicide, but you stay in power longer. They always choose door number 3. They debase the currency. Rome clipped silver from coins. Weimar printed marks. Todd, we call it quantitative easing. It's the same thing, and here's the pattern within the pattern. And when governments debase, when paper promises start to fail, what preserves wealth? Throughout all of history, every single time, the answer has been the same. Gold and silver. Tangible assets with intrinsic value and limited supply. In Rome, precious metals. In Weimar, precious metals. In the 1970s, during stagflation, silver went up 40 times from 1970 to 1 from 0. From 2008 to 2011 during the financial crisis, precious metals. From 2020 to the present, precious metals. The pattern doesn't care about your politics. It doesn't care about your economic ideology. It just executes. Act 4, the reset. This is where we're headed. This is when the old monetary system breaks completely and gets replaced with something new. Sometimes it's a new currency. Sometimes it's a new gold standard. Sometimes it's regional currencies or digital systems backed by hard assets. But the transition, the gap between Act 3 and Act 4, that's when precious metals perform their historical role, wealth preservation across the chaos. We're not in Act 4 yet, but we can see it coming. The BRICS nations are talking about a new currency. Central banks are buying gold at record rates, over 1,000 tons in 2023. Countries settling oil trades in yuan instead of dollars. These aren't random events. These are countries positioning for the next monetary system. They're buying the hard assets they'll need when the current system resets. And silver sits at a unique intersection. It's both a monetary metal and the most critical industrial metal for the green energy transition. Solar panels, electric vehicles, 5G infrastructure, AI data centers, all of it requires silver. There's no substitute at scale. UBS raised their silver forecast to $52 per ounce in 2025 and $55 by mid-2026. Those forecasts are already outdated. We're at $67. BNP Paribas said $100 silver is possible in the right supply conditions. Bank of America's technical team is bullish. These aren't crypto influencers. These are major global banks. But here's what I want you to understand. This isn't about getting rich quickly. That's the wrong frame. Think of silver like insurance. You don't buy home insurance hoping your house burns down. You buy it because you understand risk. You buy it because if something happens, you want to be protected. Silver is monetary insurance against currency debasement, against the possibility that the pattern continues doing what it's always done. The current price, $67.30, is high by recent standards. But zoom out. In real terms, adjusted for inflation, silver would need to hit $125 just to match its 1980 peak. And unlike 1980, when silver ran up purely on speculation, the Hunt brothers trying to corner the market, today's driver is structural. It's industrial demand. It's supply deficits that have persisted for 5 years. It's monetary uncertainty. It's geopolitics. China is weaponizing exports. That combination? That's how you get secular bull markets that last years, not months. And here's the part that should give you pause. We're 72 hours from China flipping the switch, January 1st. The export restrictions go live, and the market hasn't fully priced this in yet. Silver rallied hard in December, yes. But think about what happens when Western industrial users and investors realize the main supply tap just got turned off. Panic buying hasn't even started. This is still orderly. What happens when it becomes disorderly? What happens when solar companies realize they can't source silver paste? When can electronics manufacturers not get delivery? When mints can't produce coins? When ETFs need to source physical metal, and there isn't any? COMEX shorts are already in trouble. JP Morgan's vault has been cut in half. London lease rates are at 9%. And now China closes the export door. The shorts, the people who bet silver would go down, and they're staring at a supply crisis with no easy way out. Because you can't deliver paper when contracts come due. You need physical metal, and physical is disappearing. The 1980 silver squeeze happened because the Hunt brothers tried to corner the market. They accumulated 750 million ounces. The government stepped in, changed the rules. Margin requirements increased. The squeeze broke. Silver collapsed from $50 back to single digits. This time is different. This isn't a corner. This is structural supply and demand meeting geopolitical reality. No rule change fixes this. You can't print silver. You can't conjure it into existence. And the main exporter just said, we're keeping ours. So where does this leave us? What does all of this mean? We're in Act 3 of the pattern. The debasement phase. Global debt is at 318 trillion. Debt to GDP is at 328%. Central banks are expanding their balance sheets. Governments are choosing inflation over default. It's happening exactly as the pattern says it should. Silver is responding exactly as history says it should. Flight to tangible assets, supply deficits, inventory drains, backwardation, spiking lease rates, all of it. And now the final catalyst, China is cutting exports. 60 to 70% of the global supply is getting restricted. Act 4 is coming, the reset. When the current monetary system breaks and gets replaced with something new, we don't know exactly when. But the pattern says it's inevitable. The math says it's inevitable. And in the transition, in that gap between Act 3 and Act 4, silver performs its historical role. It's not about speculation. It's about awareness. It's about understanding what's happening and positioning accordingly. I can't tell you what to do with your money. I'm not a financial advisor. I'm just a pattern recognizer. But I'll leave you with this. Throughout history, every time debt reaches levels we're seeing now, every time currencies get debased this aggressively, every time major exporters weaponize critical materials, the same assets preserve wealth. The same pattern executes. We're 72 hours from China closing the export door. Silver is at $67, up 130% this year, the strongest annual performance since 1979. COMEX inventories are down 73%. Supply deficits for 5 straight years. Industrial demand is exploding. Monetary uncertainty is accelerating. Act 3. The debasement. It's unfolding exactly as the pattern says it should. Act 4 is visible on the horizon. We just don't know how long Act 3 lasts. We don't know if it's months or years. But the pattern says this. When you're in Act 3 and you see Act 4 coming, you position for the transition. Not because you're panicking, because you're aware, because you understand what comes next. So ask yourself, which act do you think we're in? Do you see the pattern? Drop a comment below. Tell me if I am connecting dots that aren't there or if this resonates with what you're observing. And if you want to see what happened the last time we were in Act 3 of this cycle, hit subscribe. Because next week I am breaking down the 1970s stagflation crisis and why silver's 40 times performance from 1970 to 1980 might be the preview for what's ahead. Not because history repeats exactly, but because the pattern rhymes. The pattern doesn't care if you believe it, it just executes. China flips the switch in 72 hours. The supply crisis becomes official, and we'll see if the market is ready. I'm betting it's not.